Hello, I'm John Jovanovic, the head of Global High Yield Portfolio Management at PineBridge Investments. I'd like to take this opportunity to discuss our outlook heading into next year and what we see as potential themes across asset classes, including high yield bonds. While 2020 was a very challenging economic and investing environment, 2021 has been characterized by a sharp recovery in the global economy and markets. The recovery has produced very attractive investment returns during the late 2020 and early 2021 timeframes, with market valuations increasing in anticipation of improving corporate earnings. As we look forward into 2022, what's in store for us? PineBridge studied market returns during different phases of economic cycles using the Purchasing Managers' Index, otherwise known as PMI, as a proxy for the speed of the economy. Recall that PMIs indicate economic growth when they are greater than 50 and contraction when less than 50. We studied asset class returns in 4 PMI phases. The recovery phase, where PMI goes from below 50 to above 50. The strong acceleration, where PMI goes from 50 to its maximum level for the cycle. The expansion phase, where PMI moves from its maximum level but remains above 50 and the economy is still expanding. And finally, the contraction phase, where the PMI goes from above 50 to substantially below. The transition from the strong acceleration to the longer-lived economic expansion was a point we looked at with specific interest in asset allocation and market rotation. During the strong acceleration phase, the best returns are in equities and commodities as they lead the recovery from very depressed levels. While credit assets, like global high yield bonds, perform quite well, they will tend to lag equity returns in this phase. However, as the recovery continues and growth begins to normalize from very high levels, we enter a more durable economic expansion. This phase is characterized by strong, though more moderate, economic and earnings growth, increasing interest rates and inflation, and continued growth in corporate earnings. In this environment, equity returns moderate as there is a review of PE multiples as well as slower aggregate earnings growth. In credit, though, we enter a period of balance sheet repair and margin expansion. As long as inflation and interest rates move upward at a measured pace, default risk falls dramatically. The underlying fundamentals for corporate earnings in both equity and credit are quite similar. Equity returns, however, required continued earnings growth acceleration and multiple expansion to produce the price appreciation that drives returns. Credit, however, only requires an environment of growth high enough to keep default risk low and low enough that it does not cause levels of inflation that result in dramatically higher interest rates. In this environment, global high yield relies on its relatively high level of current income to generate positive market-leading returns. In other words, we need an environment that's not too hot but not too cold, where we can collect our income but not be overly worried about default risk. This is the environment we find ourselves in heading into 2022. The Federal Reserve, along with other central banks, is beginning to taper asset purchases heading into next year. Further, they are monitoring inflation and stand ready to increase short-term interest rates if needed to ensure inflation remains near longer-term targets. Interest rates have already increased in anticipation of this, with the 10-year Treasury bond in the range of 1.5%. Earnings growth for the S&P 500 are past the easy comparisons from the depths of 2020's decline, and they are projected to normalize in 2022. In our opinion, this sets the stage for a not too hot but not too cold environment where global high yield is among the market return leaders. We continue to see an environment of stable credit spreads, low default rates, and total return driven predominantly by the high current income of the asset class. We expect a continuation of the current portfolio themes of targeting high coupon income, keeping the interest rate risk of the portfolio near market averages, and moderating default risk by keeping lower rated securities, specifically CCC rated securities, at or below market averages. We believe this combination positions us well for an economic environment where the economic expansion continues to unfold into the coming years. Thank you for your time and attention.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。